The product method, also known as the value-added method, is a fundamental approach used in economics to calculate gross domestic product (GDP). Here's a breakdown of the concept with an example and intuitive explanation. Core idea. At its heart, the product method focuses on measuring the value added at each stage of production within an economy. It tracks the increase in value that occurs as goods and services progress through the various stages of production. Why is it important? Avoids double counting. The primary advantage of the product method is that it helps avoid double counting, a common error in GDP calculation. Double counting occurs when the value of intermediate goods is counted more than once, leading to an inflated GDP figure. Sectoral insights. This method provides insights into the contribution of various sectors, agriculture, manufacturing, services, to the overall GDP. How it works. 1. Identify production stages. The process starts by identifying all the stages involved in producing a good or service. 2. Calculate value added at each stage. Value added at each stage is calculated by subtracting the cost of intermediate goods used from the value of output at that stage. 3. Sum up value added. The GDP is then calculated by summing up the value added at all stages of production across all sectors in the economy. Example. Let's take the example of bread production. Stage 1. Wheat farming. Value of wheat produced. $100. Cost of seeds, fertilizers, etc. $20. Value added. $100 minus $20 equals $80. Stage 2. Flour milling. Value of flour produced. $150. Cost of wheat. $100. Value added. $150 minus $100 equals $50. Stage 3. Bread baking. Value of bread produced. $200. Cost of flour. $150. Value added. $200 minus $150 equals $50. Total GDP contribution, $80 wheat plus $50 flour plus $50 bread equals $180. Intuitive explanation. Imagine you're tracking the journey of a raw material as it transforms into a finished product. The product method is like taking snapshots of the value added at each step of this journey. By adding up these snapshots, you get a clear picture of the total value created in the economy. Key points. The product method is one of the three main methods of calculating GDP, the others being the expenditure method and the income method. It's crucial to distinguish between intermediate goods, used in further production, and final goods, ready for consumption, to avoid double counting. The value added at each stage represents the contribution of that stage to the final value of the product.